Good evening, guys. Ken at Tortoise Capital for the nightly strategy report for 27th of May, 2020. Strong vote up today. So, taking a quick look at the market health check, here's our new 10-day high today. Go back 10 days down to a 10-day low. We have a strong 10-period regression line. We had the market, the MACD go from fall back into summer. So we are in the summer mode today. You can see how the RL10 turned green. So we're in the summer mode. That is a very strong vote up. And the movement in the last hour really reflected a commitment to the market going forward and going upward. So this was that the last week's 5 days in that very narrowly traded range. The previous week had a much more volatile. It started here, went high, went low, came back for a net almost of nothing. And then last week was that first step up and then solid all week. And then this week started off with a bang and finished nicely, still above last week's high. And then today gapped up, ground down, and then ground all the way back up, and then made a mad run at the end of the day to really close at the high of the day, making a new 10-day high, a 30-day high, closed just above the RL10 peak. We are outside the Z2. The next thing in sight is Z3, and then finally that Z3 extension up here at 316. The Z3 line right now at about 308. On the downside, we have Z2 at 301, long-term fair value at 297.9. The low of the day here at about 296.50-ish. Upper skin of the dragon, which is also the dragon peak at 296. The Z1 line, 294.4. The middle, the spine of the dragon here at about 290, I'm going to say about 293. Lower skin of the dragon, 289. The PSAR flip at 289.2. Bollinger Band mean all the way back here at 287.5. The belly of the dragon going back like 9 days, 284. The Z minus 1 here at 280.6. So this is a market that has no resistance overhead and closed really well. We'll see what's going on. But that's a pretty strong vote upwards. I will tell you that. What worked today? All right, so there's the S&P at 1.48. What was better than the S&P today? Well, reading up the stack, McDonald's fractionally, real estate at 2%, Intel, Home Depot at 2%. Clean energy, the Dow was really the strong index all day. Tech was underwater most of the day, and the S&P finally closed with a strong run, but the Dow had the real strength today. Gilead Sciences, Wind, Cisco, and lumber all around that 2.5 range. Real estate 3.1. Boeing, Nucor Steel, and Caterpillar, the industrial heartland, right around 4% each. Finance, another strong day at over 4%, along with Brazil, triple Dow. U.S. Steel at 6.5. Simon Property Group and Virgin Galactic, both around 6.5 to 7.3. Cliff and Alcoa, 9.5 and 11.5. So it was the materials today, you know. And these were front running well ahead of XLB. We're going to see XLB way down here at 1.01. But the metals that we follow, I mean, Nucor at 3.8, U.S. Steel at 6.5, Cliff and Alcoa, 9 and 11.5%. So just some amazing runs. And now Alcoa and Cliff in the green. So now we're starting to see a lot of things now in the daily summer. I take this as a very positive sign when you see a combination of weekly spring and daily summer. That's just as good as it gets, because on the long term, it's just made that turn out of the winter. So there's a lot of long-term swing potential in those things. And the dailies are steaming right along in the summertime. That's just as good as it gets. So when I'm tracking those seasonals on this array, I look, the two that I really love are monthly spring and monthly summer. So you see like Gilead fires in the yellow at monthly spring, and then Clean Energy, Home Depot, and Alcoa are monthly spring, weekly spring, and that's so both of those have just made that turn, and that's so Intel. I just love this monthly spring. I'm sorry, monthly summer. Excuse me, monthly summer, weekly spring. So there's been a pullback. So long term, it's good summer. Shorter term, there was a recent turning after the sell-off. So weekly spring and then daily summer. So green, yellow, green is just an amazing feeling. What was worse than the S&P? Well, Mexico, energy, Japan, Eurasia, silver, healthcare, materials, tech, and then some of the big tech names still down. So XLK is, I shouldn't say down, it's underperforming. It's still up 0.57. But Apple, Tesla, Microsoft, Google, Amazon, all worse than the S&P. So those tech leaders still are not contributing here. Some of the other index. So let's see, Devon Energy, underperforming energy, only up 1%. Merck, Apple, oil exploration. Some more that there's another tech leader that's lagging, Facebook and Twitter. So those big tech names, the big tech darlings, are just not there yet. So I really think that Twitter selling off 2 3/4 today looks like a time to go frame an opportunity, because we're looking at weekly spring and daily summer, but it was down 2 3/4% today. So that's one to go frame for some advantage. Yeah. Connecting to some long-term ideas, some strategic ideas. So when you have an ecosystem approach, you have a sense-making framework. We've been talking about this for about 2 months, about the shift, the strategic long-term shift away from China. Is made in China the new blood diamond? Well, it's acting that way. 40% of Americans will not buy Chinese-made goods. And I was looking at something, maybe it was on Amazon, and that was in bold. A selling feature of that item was that, hey, not made in China. And, as a bold statement of announcement. Yeah. 60%, a record 60% now have a negative view of the country. It's about time that the public turn negative on China. So this is one of those that not only reflects a change in the strategic supply chains, but also in the policy formation of our politicians when they're trying to stay and get in front of a herd and see where the people are going, then try to get in front of them. Classic leadership. So we're going to see that not just in chips, but in all the fundamentals. So what'll be interesting is to see how that chain of custody works. At made in China but assembled elsewhere. Is that really made in China? So how all of that shapes out, or truth in advertising, or truth in the production chain. There was regulation that was built to put ingredients on food products, because of the public's concern. Well, I was listening to a vet talking about some of the shenanigans that are used to be available in making dog food, where a bottling company would make bottles for some kind of like a liquid dog food supplement, right? And they would buy the ingredients pre-made from somebody and then simply put them into their own bottles. And because they didn't put any preservatives in, they were allowed to put on their label, hey, no added preservatives, because they didn't add any preservatives. But if you read the ingredients, you would find preservatives in there because the guy who made the solution had put preservatives in there. So there will be some shenanigans by unscrupulous people if the law allows that kind of malarkey, I guess Biden would call it. So the whole made in China. So this is where a strategist now starts applying this information to a process model that understands something about what the world looks like and how it works, and then starting to look for evidence where buying and selling statistics and volumes change as a result of people's behavior changing, and then using that to adjust forecasts and all that. Well, ultimately, that reflects in a dynamic price movement on a relative strength basis. And so all we're looking for is evidence of movement, and we're looking to play relative movements and volatility of different asset classes. So this is just one of those things to keep an eye out on. But you could see how a person who has a fundamental approach would have to try to figure out how to interpret that news and make a predict. Would you like to try to be in the position of making a prediction about how significant this news is compared to all the other news, and try to make an estimate of how much behavior is going to change and what the dollar value of that is? How in the world can you make a prediction on that basis unless you specialize just in that thing? And if you specialize just in that one thing, by definition, you're not an expert in all the other multivariable things that are affecting price. So to me, as a trader, the entire fundamental analysis logic model is not a game that I can play competitively, so I don't even try to do that. I just recognize that in an open system with lots of variability and lots of dynamism, a chaotic adaptive system, at least a complex adaptive system, that there are other strategies that are feasible for an individual trying to compete. I wanted to shift gears a little bit here. Let me just cover this flashcard about exits, because we saw it yesterday in the supported spring crossing. I added to that another module which had to do with a trailing stop strategy that was very, very relaxed. And so the logic went something like this. I've been engaged in, trying to teach people the way I trade for, 20 or 30 years. In this particular version of the RLCO and whatnot, 15 years. And in that time, because I'm trading systems that are really well suited for me, a lot of the things that I take for granted may not be easily adopted by others. So there's this, there's a learning curve, but there's an emotional resilience too that comes from lots of repetitions. So I'm always in the hunt of trying to help folks navigate the trade-off decision when it comes to exits, and all the other ones too. But and I try to render them down as simply, the choices as simple as I can. One example of that is the 2R battle drill, in which we describe the habits of mind that you should adopt when it comes to price approaching a critical state when you get the trade that you hope that you could get. So if you frame a trade with a 2-to-1 reward to risk ratio, and then against all odds, that thing actually turns into a near 2R win, well, that's what you were hoping to see. And you framed it at 2R because that was a reasonable place that it could get to before it stalled. And it wouldn't surprise you if it stalled at that location. So the essence of the 2R battle drill is that of all the possible decisions you could make, or the ones that you could rehearse, the one that you ought to be best on, the one that should require the least amount of cognitive effort and cost, is what to do if it is approaching 2R and then starts to stall. It's doing exactly what you would kind of hope that it would do with your practical mind. In your optimistic mind, what you really hope that it does is it blasts right through 2R so you can add a second position with momentum and then really go to the moon. But in your practical mind, you say, hey, I would love nothing more than for this thing to get all the way to 2R and then start to stall in an orderly manner so that I could exit under a state of calmness. So that 2R battle drill is a piece of preparation and rehearsal. We extend that idea to say, not only is that a 2R battle drill, but at any place where you have mapped out in your price ladder some reasonable place where it wouldn't surprise you that that price starts stalling, is that you can actually apply that same heightened awareness and attention to detail at that critical moment and just call it the exit battle drill at resistance, or the resistance battle drill. It doesn't have to be 2R. Like it might have been halfway up the price ladder at 1R. Maybe in the past it had stalled there. So if it stalls there again, you can't be surprised by that. Well, if the 2R battle drill is our low cognitive cost battle drill, then what I'm trying to suggest with things like the owl is to render the complexity of the of our RLCO patterns and frameworks and frogs and all of that jazz, and try to render the owl down to a simple 5-stage, 5 criteria, each one of which is mathematical, and which would allow us to do something like have an unambiguous move. I'm going to call this a harsh winter. And then it starts to reverse, and you get a P1, which is the RLCO outside the river, and RLXD, where the price has crossed the dragon. Then the dragon rolls up, and then the RL30 rolls up, and those 5 criteria, and then you buy that candle. And those are the 5 criteria that are stepwise in the owl, and that is a 5 mathematically defined criteria that allow us to get into the owl in an orderly fashion. And the more skilled at that you are, the less cognitive effort it takes for you to track each one of those things like a traffic light. When you get 5 green lights, then you can go. Well, it's it's clearly a good idea to get into the owl, because one of the things that you'll see happen all the time is you have some level of price up here at some level of resistance, and you draw that line across. Maybe that's the hump of the dragon, maybe it's the hump of the RL10, maybe it's a 10-day high or whatever. But you know that after this selling is over, and then if some buying comes in, if price is able to get above that known level of resistance, then that is an indication that the buyers are really serious, because they've left behind all of this selling, this wave of buying that now eclipses that resistance level. It's like it erases all that harmful emotion, and that sense of relief plus the actual buying pressure we think might propel that for another leg up. So this might be leg one, and that's leg two. So the owl is a way for us to play a counter trend rally, but in an orderly fashion that takes a look at 5 pieces of evidence that suggest this might actually be a swing low. It may be that that being able to enter at criteria 3 allows us to front run the owl in the same way that the owl allows us to front run the emerging dragon. We don't believe in any of those trades, because if that owl is entered and it rolls over, then we're going to reverse and collapsing dragon. And that's going to, whatever this leg down was, there's another one of those legs down here. So to protect against that, we have a tight stop, like at the PSAR or the belly of the dragon or the RL10, so that if this thing doesn't work, then we can scratch the owl or take a fractional loss, and then maybe get a collapsing dragon or a pocket entry in here and front run the collapsing dragon. Well, we've rendered this little location down here around the RLXD into the supported spring crossing, which under certain conditions makes that RLXD entry a reasonable thing to try, provided that the context is there, that there was a really harsh winter, and that we've seen the PSAR has flipped, and the RL10, when it crosses the dragon, that we're in a MACD season of spring. Now, in TC2000, because we can color code that RL10, which acts as the price, well, we can see that right on the RL10. And if that's in the yellow and it's crossing the dragon and the PSAR is underneath it, and we can see that harsh winter, and we can see an observable, reasonable target up here that pays us 2 for the one element of risk that we're taking, we can put that trade on right here at the RLXD. So the RLXD is not the reason, but it's the trigger for entry. The context of all that trade architecture is the reason to get in there, and then the RLXD is simply the trigger. It may be that you can work up a plan for Joe Greco, get your ears on, is put half the position on at the supported spring crossing that you were going to take, half of the position you were going to put on at the L, put half here and half there, and then you get a blended entry. But if that first piece doesn't even get to the owl but starts to fail right away, you're only on half a position anyway. So there's some, you could think of that as 2 parts. And then when you do finally get out, anytime after the owl entry, you're getting out of everything, is my recommendation. So increment in and then all out. Well, if we can do that, the enterer has done his job. Then the fireman takes over, and as prices moving up the stack, his job is to take that initial risk and move it to no lose plus dinner for 2, so that no matter what else happens, we're not losing money on this trade. So there are some considerations now about how to manage that exit, because the entry is pretty straightforward and the context is straightforward. And so some of those considerations look like this. Where should I put my initial risk? And I'll give you 3 choices. the PSAR, the belly of the dragon, or the belly of the RL10. One of those three is far enough away to satisfy you that you won't take more than that execution loss. I default to the one that's in the middle of those, and that's usually the PSAR. The next trade-off decision is the strategy, the trailing stop exit strategy, which is a trade-off decision managed through the life cycle of the trade. So this is where the challenge comes in for me, as trying to teach you the way I trade, and you trying to learn the way I trade. It's natural for you to try to trade it the way I trade it if you like that, but it may not feel natural. And there's a lot of things that go into the decisions that I make, and I try to articulate them, but there's a lot of moving pieces. So there's a cognitive cost of processing that information, and an attention and a focus. And the reason I put a lot of attention on that is because when this thing is working, it's not unusual to see price following this dotted blue line living between Z3 and Z2. So it's usually in the floodplain when you get a nice decisive move and it just keeps working. Watch how often that stays between the edge of the river and the Z2. It kind of parallels that. And that's what makes, when it goes beyond Z3 and then starts coming back, you say, oh, that was an anomaly, and we want to preserve that irregular gain. Well, when you get a nicely trending move on any time frame and it's moving up like this, the dragon, that orange line, pretty quickly comes along and starts tracking that right on the edge of the river because of math, because of the way math works, because the dragon is a 10-period simple moving average and the Bollinger Band mean is a 30-period simple moving average. When price is moving in a straight line, eventually the dragon's moving in a straight line, and then the river is in a straight line. So you got those almost like the lanes on a expressway, with the very, very fast lane out there between Z2 and 3, and a fast lane in Z1 to Z2, the left-hand lane at Z0 to Z1, and then start to slow down as you go to the right. Well, because of math, we want to think about what is the normal move. The range of a normal move is defined by that simple moving average 30. And then plus or minus one standard deviation gives you the boundary of normal noise. If this thing was just chopping around, but it was staying in the river, but sloping upward, well, then you have a grinding bullish move. If that is kind of a decisive move, this thing gets out of that river and it gets out here into the floodplain and just keeps going until it slows down and stops, and then it starts reverting back to the mean and the river catches up. Well, the dragon is that intermediary now between the movement of price and the movement of that Bollinger Band mean. That's the mean that when we talk about abnormal moves revert to the mean, that's the mean that we're talking about, the z-score of 0 right there in the middle of the river. If you think about what we've been saying about the Shingo model and statistical process control, one of the things that comes out of that body of knowledge is the idea that you want to simplify and standardize your normal workflow and then manage that visually. So you want a visual management of in standard work for normal flow. Normal flow in this model is defined as price in the river. So when this thing is really moving out nicely and it's out beyond the river and just marching north, that's actually abnormal behavior, because normal behavior would be for this thing to be grinding in little 2 up and 1 back, and it's staying mostly in the river. It's staying in the river and occasionally getting into the floodplain. But what you'll see is that actually when it's kind of a grinding move, you'll see price moving up in here in that left-hand lane of the river. I should draw it that way. And I draw it as a straight line, but what you'd really see is this thing kind of moving like over and then up and then over and then up, and it's grinding, and each time it's winning just a little bit, and it's kind of this is if it was moving right along with the river but up, and it was a little bit better. But the moves that we love, the ones that really pay us, that we can get a second position in, tend to be the ones where it gets out of that traffic and into the floodplain, and it just kind of runs right along there while the bullish guys keep hitting the gas, and the sellers are just selling the inventory. Like the buyers are buying and holding, and each new wave of buying is a new bucket of buyers that are coming in. So that thing just keeps moving up. When those buyers no longer come in, that's when you start seeing things like it starts coming back like this. Instead of continuing up forever, it starts giving you some of this. Well, if we think about statistics, then one of the things that we can say is we want to have a stop that allows us to let the new normal, that new price movement, let it move back and forth until it becomes abnormal. So there's three candidates for describing abnormal behavior. One of them really tight would be this dragon. Another one would be the Z0, the reversion to the mean. Another one might be, a reversion to not just to the Bollinger Band mean, but the far side Z minus 1. And then if you had a really wide stop, it would be the Z minus 2. Anything beyond Z minus 2, and this thing is really that thing is failing. It's reversed and doing that. So the trade-off decision that you are faced with here is how close should I have my stop to allow it room to breathe, but close enough to preserve the gains that I've made? Well, the first thing that I want to say is that your first order of business after you enter is to figure out when to move your stop to no lose plus dinner for 2. So let's say we had our stop down here at the PSAR. At what point and how do I decide to move that to no lose plus dinner for 2? Once I've done that, and here's my entry. What I've done is I've taken my risk out of that position. The risk to my core capital, I should say it that way. If this represents my risk, that's the risk to my seed capital right there, from wherever I decided to draw that, to put my initial risk on. So there's a couple ways that you might do that. One of the ways you can think about it is as that thing starts moving up the stack, hey, if I just had some kind of a trailing stop that paralleled price, that at some point, if this marker right here is no lose plus dinner for 2, well then, when this much time has elapsed, my stop is just mathematically has risen to no lose plus dinner for 2. That would be fine if price was always that rational dotted blue line like that. That would be amazing and wonderful, right? But it goes up in fits and starts. Maybe one of those price bars was something like this, where you had a big move in here, and it started to move up like that, and the candle hadn't even closed yet. So maybe you had something like that. You might then say, well, the fireman, if he sees that, I want him to just jump that up to here and lock in the move and not wait for the price action to slowly pull it forward. If you've got a trailing stop, well then if that thing pulled you high enough, I almost drew that to scale. Look at that. If that thing moved high enough, it would have to move this high before you would be at no lose plus dinner for two. Well, what if that thing only moved half of that distance, and you just said, you know what, that was better than the rational 45-degree diagonal line. I'm just going to use a command override and just move halfway from the top to here, and I'm just going to put that in and leave it in place until such time as my trailing stop picks it up, and then I'll let that trailing stop continue to go. So that's a technique. That's sort of like that's an adaptive response to a surprise move in your favor. That's a good problem to have. Another one of those discussions I had yesterday was, in order to not prematurely get out of this thing, because remember, you got in at a critical state and it might not immediately go in your favor. Maybe it's mucking around a little bit. You might just think about leaving this initial stop in place, because this may not be a very big stop at all, but maybe it's 10 or 15 or 20 or 25 cents or whatever it may be, and you want to give that thing room to breathe. And so you might just watch the PSAR. So if this, I'm going to, let's see if I can draw a PSAR line on here. I'm going to try to make it black. And we'll make him dotted. So we're just gonna say maybe the piece. Oh, I drew a PSAR on there. Sorry about that. So that PSAR starts wide and then has an acceleration through time. Well, you might just simply watch to see at some point when the PSAR line, which I drew way over to the right, when that PSAR cuts across, maybe that's the time that you then jump this stop up to no lose plus dinner for two. Now, quite often that PSAR won't be that far out. It might look more like, depending on how fast this thing moves, that PSAR might get pulled up here like this. At some point, it gets pretty close to the dragon. Or you might use because the dragon is actually pretty close. You might wait to see the PSAR cross your entry. So you keep your stop here, and then when the PSAR crosses that line, then maybe is when you take and jump to no lose plus dinner for two. Once you've done that, it's now a science project, and you can move on to the next phase of how to manage the trade in a managerial way, in a routine way, because you're not going to lose money. The next thing that happens is this thing is going to become an average win for you. So you've got to know when that thing becomes an average win. So maybe your average win is somewhere up in here, and I'm going to draw that as another thick blue line. Between no lose plus dinner for two and an average win, you're just watching that thing kind of grow, because you know that if it moves against you, like if it comes out of there and comes back, your no lose plus dinner for two is going to keep you from losing money. And if that thing starts to decay, you might just decide, you know what, I'm gonna meet him halfway. Sorry, let me draw it as a red line. You might just say, let me just meet him halfway, like at the edge of the river or something like that. Or you could pick some point to get out, and it's better than no lose plus dinner for two, but not quite an average win. But maybe your price action got you above the average win. So now you're up in here, which is awesome. once you're past an average win, I just feel like it's an important psychological moment that if it's up here, you don't want an above average win to come back below an average win, because this was going to make your expectancy better, and then just take the average win. So that might be a case where, in the same way you jump this stop to no lose plus dinner for two, you might end up having something like an average win exit, where you say, once that thing has gotten a certain distance, in fact, up here by the time I'm ready to put a second position in, or maybe the emerging drive, or whatever it may be, maybe that's the time that I just lock in the average win. So those are some of the decisions that I go through as I'm trying to fight my way through all of the little incremental moves, because I trade a lot and I'm trying to make fractions on a lot of positions, and I can manage 4 at a time. And so I could micromanage them 4, and then hopefully one of those 4 is going to be one that really takes off and goes. Well, what if you don't want to do that? What if you're just watching one thing and you want to reduce? You don't want to be watching it bar by bar. Well, that's where I'm going to go to this next idea, which comes back to this fundamental idea of that supported spring crossing picks a time in which there's a reasonable possibility for this thing to be the kind of strong directional move that features this long, strong move that stays out of the river and just keeps marching up the stack. And then only after a really nicely measured move does this thing start to decay. Well, that's the kind of time where if you can stand it, you have a nice you can pick one of these z-scores to be your stop, and then just let that run. So you're not trying to micromanage the PSAR stop or the southern skin of the dragon or the edge of the river. Well, all you're really doing is you're firing and forgetting. And we saw 3 examples of that yesterday, in which they returned like 7 or 8 of these execution risks individually, like 7 or 8 steps up the ladder. Does that happen all the time? No. But it happens enough that might be a nice relaxed way for you to get in there and manage. And you could even just let that thing go. Once you're at no lose plus dinner for 2, it's really just a science project anyway. So this is a chance for you to now start experimenting with some of these other ideas. And one of the things that I would say is, if you pick, like, I would start with like the Bollinger Band mean or the Z1. To me, the Z2 is reasonable if you're looking at an individual symbol, because you might actually get sharp reversals. Like all of a sudden all the buyers disappear and then there's a sharp drop. That is less likely to happen on the big fat indexes. I mean, it can, but it's less likely. So if this is like a company, an individual company like an Alcoa, Z2 might be the one that I use, where I might do something like, well, the PSAR stop is always going to be closer to price than the Z2 line. The Z2 stop would probably be way down here, just representative. I'm going to put it right here at the edge. So maybe that's where the Z2 is. And maybe that's so far away that you don't want to give all that back anyhow. So what you might do is put your initial risk right where the critical state indicates, and then you just watch this Z2 line. And then once the Z2 line picks up, well, then now the Z2 line becomes your stop. And now you just play this rule. And you take that exit. We saw a couple cases of that yesterday, where in an orderly move, it was 7 or 8 of these execution risks. And it's the same argument if you wanted to do a Z minus 1. I kind of like the Z minus 1 as the trade-off between the Bollinger Band mean and the Z2, because according to statistics and the way we've sort of defined our little manufacturing process, if I bought into the hypothesis for this supported spring crossing, then it's because when it works, it's going to be one of those moves that stays in the floodplain or even gets out by the Z3 on occasion. And it just, it's a freight train running away, and making bank up there. And that run is still in play until it crosses back over the far side of the river. Like it might come back to the Bollinger Band mean and then resume. And that would be absolutely normal behavior. That's what it's supposed to do. And in fact, if this run up was so strong, it might even actually come back to the Z2 and then resume. So it would come all the way over to the Z1, Z minus 1. Both of those we would consider to be normal behavior. It's not until this thing leaves the river that it suddenly becomes abnormal, and that's where that Z1 stop goes. So only 1/6 of the time should it go from a strong move on the left-hand side and then cross over that line and then revert. So 5 out of 6 times that it crosses that Z minus 1, that long run was done. It turns out that it wasn't one of those. That was as good as it was going to be. So I'm going to suggest to you that you break this into a couple pieces and that you treat this whole piece right here as one thing. Getting the entry and then the move to no lose plus dinner for 2 as a battle drill and get that done. And then the second one is what to do between no lose plus dinner for 2 and it just tipped over into the above average win. That you might treat that in the same way that you moved from the initial risk, bam, to the no lose plus dinner for 2. You might lock that one into bang, an average win. Treat that as a battle. And then the third one, by the time all that happens, you're probably just trying to figure out, well, which one of these Z scores am I going to use as my trailing stop? To pick up the management so that the management rule is there. Now, even if you commit to a Z0 or a -1 or a -2, you can always decide to just say, you know what, that was enough, strike, and just cash. As long as it's better than you're committed. Let's say in this case, there's my Z1 exit. If I just decided to take it there, all I did was use trader discretion, trader quality number, captured more than the Z minus 1 or the Z0 would suggest. And I can always use discretion to exit sooner and better, but never to lower the stop once I've committed in my mind to one of those lines to be my guide. Now, after you do this for 15 or 20 years, you might feel more comfortable trading more often, 40 or 50 times a day, with 3 or 4 things in your hands at one time, the span of control issue. And in that case, you might tolerate less and less give back so that you can have larger position sizes that are getting you paid more sooner. That's the corresponding value of having the tighter and tighter stops, is that the minimum manageable risk box gets smaller. But that is going to lead you to trading more often. I like to make those decisions because I make them in my favor. But these are the ways that I would understand that a new trader to this technique could start taking on these ideas whoops, let's get that out of the way, without trying to replicate exactly what I'm doing. You'll see it. Well, Ken, why did you decide this time to use this and that time to use that one? Because of context, because I'm looking at sectors and volatility and markets, and I'm integrating a lot of different indicators from different screens. But if I'm just trying to concentrate on developing conscious competence, and I want to screen out some of those other things, maybe the relaxed way to do that is the way that I just described here, and that is start with that PSAR stop or belly of the dragon or something. I like the PSAR. And then get to no lose plus dinner for two. Then you can just relax. You're not going to lose money on that trade. See how that feels. And then use, like, if that's around like a 0.3 win, just figure that your average win is going to be 0.7. Why do I say 0.7? Well, because you set a theoretical reward of 2.0. You thought that thing was going to give you 2R. So take 1/3 of that. That's 0.7. And let that be your working average win. When your win gets beyond 0.7 in hand, figure out how you can turn that into, well, I'm not going to do any worse than average. So if it gets to 0.9 and you lock in a 0.7, you're only going to give back 0.2. Then just leave that in place and then make a decision that you just leave it there until whichever line you decided to use picks it up, and then that becomes your management one. At the same time, I would also say, look, if it had a runaway train and it got more than one of your management boxes away, just trail it with that box and you'll really be happy. So there's a couple ways for you to work through a strategy of exits that gives you peace of mind, that lets you feel like you've made the trade-off decision between give it enough room to run, but don't give back too much of a good win. That's the internal psychology that only you can monitor and manage. And then the management tools that allow you to work through that are some of these considerations over here that I've just talked through. Figuring out your initial risk. The idea of the no lose plus dinner for two. The 0.7 of your average trade. At some point when you've got enough of these things under your belt, you can use your average trade. The role of the PSAR now really acts for me as my guide on where I like to have my stop. And it's usually somewhere between, in the early stages, it's somewhere between the Bollinger Band mean and the skin of the dragon. And that's where it quite often looks like this hand-drawn black line, that it starts wide and then begins to accelerate over time, and it acts like a time stop. The thing about these diagonals, or the Bollinger Band means, start acting like a accelerating stop, because at some point when the price stops going straight up and starts pulling back a little bit, that's actually evidence of volatility shrinking, and that will accelerate the Bollinger Band lines. Watch how that happens, that as the train starts coming into the station and starts slowing down, watch for that RL10 to roll over. Watch what happens when the RL10 rolls over. It will look something like this. That thing will just be going up and up and up, and then price does like one of these little 1, 2, 3 things, and then the RL10 is just going to roll over. So somewhere around in here, you'll see the Bollinger Bands start compressing because the volatility is shrinking. It used to be this wide, and now it's only this wide. So watch the phenomenon of those Bollinger Band means, how they change shape. Let's see. Now, one of the other things to watch is when Now, this is what happens when you have that harsh winter, but just while we're here and speaking about Bollinger Bands. Now, if you're in the other pattern we like, and that is you have that really tight Z3 pinch, and then price breaks out of that and starts running up. Well, what'll happen is that the northern Bollinger Band will start to expand and go up like this, and that lower Bollinger Band will initially cut down and then turn and follow, and you get this kind of a phenomenon. So I'm going to draw my initial stop here in orange, in orange, so you can see the distinction, or in purple. God dang it. In purple, so you can see the distinction. So if your stop was down here like by a PSAR or a Z3, now when that Bollinger Band mean finally turns, now you could let that pick up the one and go, whether that's the Z3 or the Z2 or the Z1 or the Bollinger Band mean. If it was the Bollinger Band mean, you would see that thing start to look like this. It'll be in the middle of those two Z3 lines, and then it will turn and go. So you really do have some choices in there about which one of those decision rules to take over for you as a default stop. You might always have, you might just solve this, Ken, this is way too hard. Whatever my minimum manageable risk box is, I'm going to start off with it really tight. I'm going to keep it there until I can move it to, as it starts moving up the stack, aha, no lose plus dinner for two, and just lock that rascal in. Bang, now it's good to go. And now I can just let these other things go. Now, the difference between this Z3 pinch scenario that I just drew and this little Z3 breakout that I just drew in here, the difference between that and the supported spring crossing is it didn't have a harsh winter. It was characterized by the absence of directional move. It was a sideways quiet channel. But ultimately, here's what happens. Your harsh winter might actually have just been something that started up here and then just quietly got quiet, and it never broke out until suddenly it became a sideways quiet channel, and now you're still in that same critical state. What's common about both of those is that the size of your initial risk here is small, and the size of the risk here is small. The minimum manageable risk box. And in both of those, you're trying to figure out how to get your stop to no lose plus dinner for two in a hurry. How can you get there in a hurry? So there is actually a commonality to that initial decision making that you do, which is trying to create frames at critical states that minimize the price you pay to find out that hypothesis failed, the minimum manageable risk box, with a reasonable possibility of a large move compared to that MMRB, and that's what the supported spring crossing suggests. The supported spring crossing suggests that simply because of how harsh the winter was. That winter was so harsh that maybe there's a rebound back to fair value. That harsh winter might have been overdone. And in the same way that's just like a bow and arrow, and they pulled it this far and then it snaps back. That's what you're doing with the supported spring crossing. That's the context that makes that RLXD entry so powerful. By the same token, the absence of that move, the abnormal sideways quiet channel, creates the potential for a move in either direction. That's what that super pinch and the Z3 pinch acts as. The supported spring crossing is a directional move going this way. But guess what? If that fails, then it's a collapsing dragon, and the size of that move is the size of this move. So what we've really just built is another way to look at chain trading. Like this whole harsh winter, that might have just started from the opening with a hybrid frog move down, the unambiguous move, and there it goes. So now we've recreated the entire life cycle of chain trading. And now we've placed supported spring crossing, the owl, the emerging dragon, collapsing dragon, pockets and PSARs, and exit strategies now. These are all elements of the trade frame. I want you to notice that it takes me 15 seconds to describe the mechanical entry for the supported spring crossing. And it just took me 45 minutes to talk through the planning considerations for how to manage the trades and manage the stops. That should tell you about how much time you should spend fiddling around with the improvements to the entry versus figuring out what you want to do for an exit strategy that allows you to accommodate all of those considerations. I've drawn 3 different regions in here that move to no lose plus dinner for 2, locking in the average trade, and then how to use a simplified form of capturing the reasonable profit so that you don't beat yourself up about that, and suggested a bunch of different ways in which you could do that. That's pretty good stuff right there. That's where you ought to be spending, for every minute you spend on trying to fiddle around with the supported spring crossing entry, you ought to be spending 45 minutes perfecting your craft, or honing your craft, not perfecting it, but aiming for perfection, but looking to improve your own articulation of your exit strategy. You should practice describing that strategy in a thesis sentence, a reward capture paragraph, a risk management sentence, and that's your elevator speech for how to perform your exit management strategy. That exit strategy is a plan all in and of itself. And then no matter what technique you're using to get in, it turns out that you can get into and trade for any number of reasons. That's the simple part. But then you manage them all in a consistent manner. 7 ways to enter, 1 way to manage and exit. That's where you gain efficiencies on your battle drill. So it's not just the 2-hour battle drill. The 2-hour battle drill is really the way that you understand the theoretical exit after a really good move. But the same kind of logic that you use to preserve a 2-hour win is what you can do at any measured resistance level. That's such a good idea, I ought to just shut up right there. So that's what I want to say about that flashcard. Now, fortunately, there's a clean version of that, so you get rid of all this darn scribbling. So I'm going to get rid of that and say don't save it. You should listen to that little 40-minute discussion as often as you listen to the 2-hour battle drill until you could give that speech about your chosen strategy as it overlays on that little template. I want you to notice that there are 3 different ways to get after this. One of them is the strike. And that's the one where you say, look, I'm going to let my firemen just decide how to do that. That when the time is right, I'm just going to keep my stop here. And then when he sees the right moment, and he'll know, he's just going to jump it up here to no lose plus dinner for 2. And then I'm going to let my Bollinger Band mean. And as soon as the Bollinger Band mean picks it up, then off we go. And that's going to be my strategy, period. So that's kind of the decisive move based on trader judgment. A second one just says, let me leave this in place and just pick up the Bollinger Band mean, and I'm just going to live with that. And whatever it does, that's what it does. And if I have minimized the size of my minimum manageable risk box, my losses are very small, and then I'll just get whatever I get. And then whenever this thing comes out of there, I'll just take whatever that is, and now my cost of management is low. In fact, I can just let the robot do that. And now I can manage 4 or 5 open positions. Or maybe I just do a combination. Yeah, I just do as soon as I'm at no lose plus dinner for 2, I just leave it alone, and then I let the robot pick it up that as soon as the Bollinger Band mean is good, there we go. If I get past 2R, maybe or the PSAR gets out of the river, then maybe I just pick the edge of the river. Or I pick the PSAR. You design that. The more relaxed one is just say, look, watch the PSAR. When the PSAR comes above, then maybe that's the time that I use it. Or maybe I just use the PSAR, like that orange dot that looks like the dragon right there. Maybe I just use the slower of the southern skin of the dragon or the PSAR, and then just follow that all the way up the stack and just live with it. So there's 3 or 4 different ways that you might start crafting your experiment. So what I would do is define a couple that make sense to you, and then forward trade those in the same way that we trade the bar by bar, and then see what the results look like and how it feels in each moment. Record your feelings and your satisfactions and your observations as you go forward. Now, you should do that right now on the trade frames that I'm going to take us through, because I've set up a number of these. I actually have 20 examples. We're not going to go through all 20. That would take us until the weekend. But think about that while I get the next thing queued up. I got one more lesson to get to before we do some bar by bar analyses. So you can download that flashcard from the handout section. I think that's gold right there. I spend more time on that than I do fiddling around on any other thing. I spend more time fiddling on that and trying to work my way through that than on any other thing. And I use all of these little indicators simply to give me interesting candidates that have a probability of moving. That's all. Okay, so empty your bowl. Now, for those of you that were in here yesterday, this is a daily chart. It doesn't have to be, but it could be. It could be something else. But this is a daily chart on something that we framed yesterday as an anomaly, and we said, man, that's really strange. The whole rest of the market was up big yesterday and then sold off a little bit towards the end. But yesterday was a big vote up on a Tuesday after a long weekend. So we were Excited about that. Only one thing yesterday sold off. This thing. And this is what it looked like. There's a couple things I want you to notice as we look at the ecosystem here. It was in the, as you can see down here, summer, fall, winter, spring. A little bit hard to see that. If I made that big enough so you could easily see that, then we'd have less fidelity up here. That's easy. TC2000 version 20 lets you color code the line segments in the RL10. Jesus, is that sweet. One of 50 improvements Danny made in the bundle for TC2000. You know, for a one-time payment for a lifelong executive assistant that never gets tired, man, what's your time worth? I'm also going to tell you something pretty interesting. I got a note from Alex Ressos last night. Now, he is a PhD lawyer IT specialist. He's not only a wirehead, but he's a lawyer who works with hedge funds in Singapore and grew up in Netherlands. Go figure. Think about the backstory on that one. Well, he and Joe, who's knocking it out of the park these days, came to our boot camp last summer and in the fall, and now Alex is crushing things. Well, he's in the middle of a project with he's got about 25,000 lines of code on a robot that manages all the things that I just said. And I'm working with him on a design document to automate this. Imagine if you defined your strategies and just plugged it into the robot and then used the TC2000 bundle to come up with your target identification and critical states and then handed it to robot to manage. Holy smokes. So at some point, that thing will be mature enough to release it to the world. He's going to use it for managing his own hedge fund, but I persuaded him to think about licensing a version of that. Way too soon to know any more details than that, but that's coming. I see Ashok asked me, can we color code the MACD also? Yeah, I just haven't done it yet. I wanted to get the signal line. In fact, now that I can take the RL10 and color code it, I'm this close to just pulling the MACD histogram off altogether. But because not everybody can do that, I leave it on there. But yeah, in principle, you can color code any indicator based on the conditions of another indicator. So yeah, you can do that with TC2000. I'll try to get that done by tomorrow so you can see what it looks like. So I want you to notice what this thing has done. This had a nice long run up here beyond Z2. So this was at the end of a really nice move. And notice, it was in this land between Z1 and Z2, so it was in the floodplain. And then it couldn't stay there anymore. And then the RL10 rolled over. And now this thing just drifted back. Edge of the dragon, RL30, spine of the dragon, southern skin of the dragon, the river, RLXD, PSAR. Hey, that had 10 bars in which you started getting these warning signs that, yeah, it's no longer doing this thing. It's now that thing. And by the time it got to here, it went from summer to fall. So that run was done. So just imagine whatever rule that you're leaning towards. You say, well, here is my Z1. Hey, on this one, the Z1 stop never got me out until here. The Bollinger Band mean stop got me out here. The RL270 here. The PSAR here. The river there. The RLXD there. The spine here, etc. I think what I do is that based on how much money in hand I have, that tells me how aggressive I want to be at capturing. And then I also look to see how explosive, like if this had gotten past the Z3, there's no way I would let it come all the way to here. But here, I don't mind this southern skin of the dragon and just taking that exit right there at the transition from summer to fall. So that's kind of a living case study of that last hour of discussion. That's what the end point of a supported spring crossing looks like after it really succeeds well. And I'll tell you that in this particular symbol, we had 5 positions on the swing trade all paid for. And by the time we exited this thing, we ended up getting out of this on a 1, 2, 3, like right here, and didn't wait for that because we were worried about a gap down and a sell-off. But I digress. So now this thing, all you got to do to read this is a strong move that was on the Z2 line all the way up, rolled over in an RLXD, PSAR, 270. I would kind of call this tried to find one support at the Bollinger Band mean, failed. Came down, found support in the river. The dragon came through, found support north of the Z1. By this time, this sell-off was significant enough that the MACD had now become winter. So even though price is going up, this is still winter condition and is subject to these sharp sell-offs. And in fact, notice this one. Big gap up, almost to the favorable Z2. Hooray! Everything's well. Psych. It not only leaves Z2, comes through Z1, through the previous day's high, through the previous day's close, through the Bollinger Band mean to find support at the edge of the dragon. Ouch. That thing went from 132 to close at 125. A 5% intraday sell-off after a 3% positive gain. And then it sold off 3 more days in a row in a step-by-step fashion. I also want you to notice that this thing would have been a 5-day down, except now here is a close, a lower close, 2, 3, 4. It would have had like 5 lower closes in here, except for the fact that this one was out of the sequence, right? So the clock would have restarted. Now this is a 1 day down, 2 days, 3 days. And so that wouldn't have fired on a 5DD. But you can see that if this thing had just closed, $1 higher, then that would have been an orderly 5-day down. So sometimes you can see pattern. In fact, the fact that this actually closed lower and then still couldn't hold, I actually think this is a better short than if it had just been an orderly sell-off, because this is telling you how painful that was. I want you to notice that all the price in this tall bar that was north of the previous day's high, this is all in the green zone, but it's failing. Somewhere in here, you just say, at the halfway point or like at the Z1, you just say, look, if I was long on this thing, I got to get out in here. Either maybe I bought it at the open thinking it was going to go up, but if I got to get out in here or here, I can't let it get back in here and here and here and here. I don't have any belief in this thing. It's failing at the same location that it failed before. Here, it couldn't go any higher. And it failed from here at 132.5 down to 120. 10%. It failed. And now this thing slowly climbs out and starts failing. Are you surprised that if this thing were to come down into here to the PSAR and below? No. One of the things we looked at then was this had become a sideways quiet channel. Notice inside this less than half the river, you have the RL10, the RL30, the RL90, the RL270, sideways for about 10 bars, except for that anomaly. But the dragon is going sideways. Sideways quiet channel dug near a super pinch. I'm going to discount that one, just say that's a super pinch. So we framed that as the yellow zone, 5 cents above and 5 cents below. And we said that orange dot just says, I'm going to start with a hybrid frog and take it in the direction that it goes. I'll use the yellow box as my minimum manageable risk box for my swing trade, I might get an even tighter box if I intraday trade it. But if I just want to trade this in a relaxed swing manner, I could simply use that and leave the stop in place and see how the first day goes, and then manage it from there. Like 15 minutes before the close or at lunchtime, I might check and say, oh, I'm in that position. Or I might take the trade in the direction that it breaks out and just trail it with the yellow box in the same way that we would trade like a relaxed frog. Although instead of a frog box, we're just using the whole range. So that's using the frog rules, but adapted towards a different time frame. That's hybrid trading, my friends. So if that's our trade frame, I want you to notice if you were using the end of day bars, this is what you get. Oh man, come on. You got to be kidding me. Why isn't that letting me adjust that square? Oh, I know what happened. I saved the file and that freezes all the indicators. Daggone it. Well, let me show you what happens in the interest of time. God, does that make me mad? I know what I can do. Hold on. So this is Walmart. I want you to notice that Walmart ah, that's pretty. I'm gonna take another snapshot of this just so that we can work the issue. Well, I just want what I want you to notice is that it opened about where it closed, blipped up for a half a second, and fell through the box at 123.50, went as low as 120.70, and then worked its way back up to close at 122.48. If you had used that box as your trailing stop and came in with the end at the end of the day and just wanted to check to see what had happened. Come on, Kenneth. Trying to size it correctly here. Excuse me. There we go. So from the peak sell off, our stop would be right there at about 123. So we'd still be in the money on that one. This might be one of those where um, you may not want to give that whole box back. So if you get there about 15 minutes before the end of the day or half an hour or whatever, have an alert. Hey, if you're an end of day trader, then you're going to walk into your trading room and say, "Oh, that's what I'm holding, and I've made this much gains so far, and now I can decide what I want to do." You're holding this much money in hand. And I've made a little over $1 on about $1.50 of risk. So I'm holding about a 0.7 win with as an end of day trader. Watch what happens if you become a 30-minute trader. If you're a 30-minute trader, here's my, here it is. If you're a 30-minute trader, it opened here. You get short right there. Look at Z3, 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 Z3. Now back in. Now you get a 1, 2, 3. Maybe you just want to get out here at the Z2, or get out there at the Z2 line, or here at the edge of the dragon. And now you've that is a relaxed day trade right there. And notice what you have now. Harsh winter, spring, and now I'll tell you, in the last half hour of the day, what do you do with this position? I'll ask you to commit to that right now. That's where I was going to spend 20 minutes on this thing, but we don't have time. The real question is now, is this one that you want to hold because you have on a 30-minute chart, which I think is a reasonable way to swing trade. That's the fastest swing trade we have. You could buy that right there at 122 and a quarter with the stop right here on Walmart. And when we look, Walmart was the only thing in the entire Dow today that gave us a negative NDX. So when you go look at the daily report, which you can download in here, and we go look at the Dow the Dow tactical summary. Walmart was down 1.1%. It had an RSI2 value of 4. The only thing in the Dow that sold off that harshly. It's extremely non-volatile. It's 2.2% ATR, means it has relatively low volatility. That's amazing. Look at all these other things that broke out to 10-day and 1-month highs today, except Walmart. Walmart didn't. Walmart is the most negative Z stretch on the daily pinch and stretch report out of the 60 members of ETF 30 and the Dow 30. Only it and Treasuries are south of the river. Here on the auto framer is some framing data. If you just want to use the daily charts, it gives you a 2.8 to 1 reward to risk ratio to the 10-day high, using $2.70 as a risk. Only Treasuries and Johnson & Johnson in the stack have similar characteristics. Walmart is in the spring and near the bottom of this Red River. So it's a value play. And then when you look at the multi-time frame NDX, only Walmart made a 3-day brand new low on that 3-day NDX at minus 61. That's how bad that thing was. Look how good everything else is compared to their own last 3 days of performance. That stands out like a sore thumb. So Walmart is the anomaly. And what I want to suggest to you is that if you were even just a 30-minute trader, If you got short where you're supposed to, according to our little trade frame, you got short right there, and you took any kind of reasonable exit, like right here, on the gain that you made in there, and now guess what? I want you to see something else. Look at the difference in position sizing that you can have. If you were an end-of-day trader, your minimum manageable risk box is yesterday's range. That's this big yellow box here. That's this box. If you're managing the intraday trade, you're probably using the PSAR. So you can have like twice the position size on this breakdown. If you were using the edge of the dragon, you have 3 to 4 times the position size. Look how fast you can get to no lose plus dinner for 2 on 30-minute charts. By the time this moves on the second bar, you could put your stop right there, and you're not going to lose money on that trade. And you might just use the previous bar's high, and when this thing closes, you drop your risk. Watch this. Drop your risk to here, and now here, and now here, and now here, and now here. And when that 30-minute candle makes a breakout, there's your exit. And now on this one over here, let's see if I can stop that. Hold on. Now look at the gain you just made. You made that gain. Compared to either this small risk box or maybe more reasonably that one. If you pick the Bollinger Band mean or the PSAR, the active PSAR. So that's almost a 2R win on a much tighter stop. Look how small this one is. That's about $1. So if you were trading $400 of risk, you would have 400 shares because you got a $1 risk, and you made $2. I think you made $2. Yeah, you made $2 per share. So you're up $800. But if you were using the end of day data, you've only got about $200. So you could use the money from this intraday gain to fund the overnight risk, and maybe only have, you keep 20% paid for by the market's money, so you have no exposure to your core capital. So that's the power of the 30-minute bar to be one of the transition points between pure day trading and pure swing trading. It was set up as a swing trade, one day at a time, because of that range compression in the dragon in the middle of the river in a sideways quiet channel, and it broke out. Because that's a critical state. If I can just be on a 30-minute bar, not the 1-minute bar, a 30-minute bar. And now here's your supported spring crossing at the end of the day. I'm buying that one right there at 122.25 with a, that looks like $1.50 of risk. Call it $2 of risk. So 200 shares. And we'll see what that does tomorrow with the open, and we'll come back and manage that one a little more. Okay. Um, I haven't spent as much time in the strategy sessions on this kind of transitional state. It's either kind of like swing trades purely or 1 minute bar. That's a 30-minute intermediate hybrid. I should do more of that. But I want you to notice how you can use end of day data to set up these trade frames, and then at very little overhead, just wait for the, you frame that mechanical trade and then see what happens 30 minutes in, and then just manage off 30-minute bars. And then you can make a decision about whether to hold it overnight. Just in the last half hour, just go take a look at it, see what's going on, and make a decision to hold some or none. Here's a trade frame in something. Daily charts. It closed. It closed right here at the number 6, and then the indication was the indication is going to open right at this new VWAP. So the VWAP closed here. That vertical blue line is yesterday's close and this morning's open. So what do you want to do with this? 1, 2, 3, or 4, or 5? So the yellow box is the trade range for the day. This is like 30-minute bars. So 7 is a mechanical entry south, and that's the low of the day, was right there at 7. And the high of the day was at 5. But when you look at this thing on 30-minute bars, so this is the same trade frame as this one, only instead of having just one entry and point on either side of the box, when you frame that with 30-minute and you see where it opens, now this thing is opening right at the yellow dot, or the VWAP. I could reasonably enter long at 1, hoping that it would just get to the high of the day at 5. There's a 2-to-1 reward to risk ratio, just aiming for the high of the day. So I could think about getting long at 1 or 2 or 3 or 4 or 5. I could also look at getting short if it went down through 6, which is the edge of the river, or the edge of the floodplain, 7, the mechanical entry, 8 at the Z3 excursion. So that's your hybrid trade frame, only what we were doing with the 1-minute bars and sideways quiet channels. You have a sideways quiet channel here, but on 30-minute bars. Notice that this is fractal. Same thing. You see winter, spring, and rising. All of the 3 of the 4 regression lines are in the river, so it's a sideways quiet channel, but it's running between the RL270 and the VWAP, perfectly poised in the middle. Sketch your quick trade frame and make a decision. Are you short yet? Winter, are you short yet? That's a Z3 breakout. Touch the VWAP. If I got short here and my risk was the far side of the river, or the VWAP, or I'm sorry, the PSAR, If you answered yes on the first time I said, "Are you short yet?" you were short here. And you really got to be short here. That's the Z3 breakdown. So one of those two. Or maybe say, no, I wasn't short yet, Ken, so I want to get short here. Okay. Now, I want you to know if I'm short at any one of those positions, personally, on that kind of sideways quiet channel, this far into the trade, I just have like a dividing line in my head. I am not going to let this thing move against me like this. Like, hell no. Because that's where I get short right there. Now, right now, I don't know if this is going to be a winter sell off. This kind of shenanigans here. Like, I don't know if it's going to do that, but it could. So I got to think about at least putting my stop like right here, so I can get no lose plus dinner for two, and that's pretty close. To like where this Z3 excursion would have been like right there. So that's going to be my stop and reverse line if this thing doesn't work. And then it would be a fake one go to. Can't remember what this one even is, so we'll see what happens. But that's where I am right now. Again, this is me just stair stepping my stops coming out of the lunchtime because I don't like losing money. But you can also make some decisions now, like, do I want to have my use the Bollinger Band mean? Use the PSAR extension? The Z minus one? Let me try to draw that. That's probably about right. That's about the Z1. I'm just going to split that difference and say that's probably what the Bollinger Band mean would look like. And so even as I start, necking that thing down, I might take the so the PSAR's kind of in there already. So I got my big fat stop right here, and I have accelerated it even faster than the most aggressive of the trailing stops. If I were to use like a trailing, an actual pure trailing stop, this is the size of the risk. So my stop now would be something like, oh, it's right where it should be. So maybe that initial minimum manageable risk box ain't so bad after all. What am I spending all this time horsing around for? I don't know. Doesn't always work that way. Bing. And that was my stop and reverse. So it looks like maybe a fake one go two. So I've got one trade in from here to here and made a little fraction. Didn't lose money. And that's all I care about. Don't like losing money. I'll try to get better at earning more money, but I just don't like losing money. Because if I can't make money trading, I have to work for a living, and that sucks. Fake one, go two, anyone? I don't care where you get out of that. There's a P1. Edge of the Dragon. There's a PSAR. There's an RLXD. You tell me what you want to do. That's also a the Z plus one. If you were in the Bollinger Band mean, hey, let's look at it this way. And this is where you got to decide through practice what exactly you feel comfortable managing. Because here's that risk. Because what do we have there? We have not just a fake one go two, but we actually have a supported spring crossing. Not quite at the place where I hit it, but right here. Supported spring crossing. Right there. That's where the winter turned to spring, crossed the dragon. PSAR flip. So now you just tell me, would you be which one of those would satisfy you? Skin of the dragon after that. Notice up in here how this thing stayed in the floodplain the whole way up. Once it got into the floodplain, it stayed there. I wish that would rotate. That would be cool. It stayed in the floodplain or better the whole way up. That's the move we want. That's the one where now the dragon and the PSAR just worked just fine. If this had been monkeying around instead of this big move up, it would have come back in here. So I actually don't mind. Let's see, let me get the pen here. PSAR wasn't bad. Hey, maybe you wanted to do the Z1. You would have had the PSAR until the Z1 picked up, and then it's like this. And now you're still in the trade. Do you mind still being in that trade? Well, yeah, because I can see that it didn't fail in here. Yeah, you didn't know that when it was failing right there. But if you had the Bollinger Band mean, or the Z1 or the Z2, notice that you're still in that trade from the supported spring crossing. The difference between those relaxed styles and mine is that I get that thing paid right away. And I don't take this open risk. Or maybe you were the Bollinger Band mean guy as soon as you could. As soon as the PSAR crossed the Bollinger Band mean, maybe you said, I'm just going to take the Bollinger Band mean forever and see what happens. That's fine. You get paid to make that decision. I will also tell you that if I saw that right there, no matter what, when I see the RL10 roll up, I don't care which one of these was working. If I had any of those as my my theoretical piece, when I saw that lock in right there from wherever I was trading it, I'd have that locked into here and peg the bottom of that. Why? Because that's the line that gives you the collapsing dragon, or even this one. Either one of those two lines gives you the collapsing dragon. So if that's where I want to get short, why would I accept a stop lower than that anyway? So I tend to peg those in. So you could reasonably have any of those exits. Holy smokes, huh? God dang it. Lock in the PSAR, lock in the belly of the dragon, peg this one here on a 3-bar low. You know, you just make some decisions when you're managing. Now, if I'm doing swing trades, each one of these bars is one day. If that's a 30-minute bar, you could find ways to manage that, I think. If it's an end-of-day bar, you're managing those at night. Still in the trade. What do you do at that doji? Ah, shit. Well, you don't reveal the price action. I was trying to draw a box. I was going to frame this one and say, where did you want to get long at or short? So I was going to draw these boxes in here for you and say, do you want to get long on the breakout or at the Z1 or the PSAR? And where do you get short? At the PSAR here. Belly of the dragon, belly of the RL10. I also want you to notice that depending on, I can't really see what the previous price action was, but this might have been, if there had been a big harsh winter and this was slowly spring turning and you get the supported spring crossing, then you get long at the green dot with a big fat stop. Right there. Now, if you were in that little blue doji, right, or that blue circle doji, and if you were long at the green dot, would you be offended to just put a stop there and say, you know what, no matter what, I'm not going to lose money? Maybe that's too close. But if this thing doesn't go through that next green line, then it's going to fail. And why did you want to? You've had 3 full minutes for it to gain and get across the Bollinger Band mean, and it didn't. So how long do you want to give it? Plenty of fish in the sea. Whew. Gains. Same thing. Doji that way. This is how you can practice your trading psychology. Short collapse. That looks like that mirror image now of the harsh summer, fall. I don't think it's symmetrical yet, but imagine by this time, aren't you noticing a harsh winter becoming spring? I can't enter yet. It hasn't PSAR flipped, but I got a spring. That was the predecessor. That little doji right there. There really was a harsh winter. And now This is where you could have gotten that entry and entry anywhere in that little cluster. And then that's what gives you, even if you waited for that little doji to enter, if you entered in that doji here, and now your stop is down here, PSAR. Don't even worry about a second position. And you're just aiming for the VWAP anyway, and it made it and then started to sell off. Wouldn't you just get out? Wouldn't you just want to get out there? The dragon couldn't hold it. The edge of the river couldn't hold it. Wouldn't you just get out and take it? I would. I've got like 20 more of these, but the point is made and it's 10 o'clock. So you've got the daily reports, lots to choose from. Plenty of things to think about for your exit. That really matters. Today was a big vote up. I would look, if you're wanting to get long, all these things that had the best scores on the 3-day NDX were the biggest breakouts. It was finance today and the metals. Holy shit. I mean, man, you don't even want to see Alcoa on this one. I was going to start with that, but I mean, Alcoa is ridiculous. Look at this damn thing. Excuse me. All it did was go from this harsh winter, supported spring crossing right at the edge of the green line. And that's from $9 to $9.90, a 10% gain after that winter harshness, and never looked back. Even if you got out on this little reversal up in here, you love that move. Holy smokes. Cliff, same thing. This is the pattern here, man. Harsh winter, supported spring crossing, right in the nook, right in the elbow in there. I'm not even talking about the plays where you can, like the owl that goes from here, from orange dot to orange dot is an owl. And then when this thing breaks above the double hump of the RL10s, or the hump of the dragon, that's the emerging dragon. Damn it. So even if you wait for the emerging dragon, you're buying that thing here. Your owl entry is when spring becomes summer and it leaves the river because it took that long for the dragon to roll up. So this orange dot here not only reverses that short, but that's your supported spring crossing. Here's your owl. Here's your emerging dragon. Pocket continuation, summer, fall, summer. Summer, fall, summer. So 5 different places you can get in with low risk. And then I want you to notice, now suddenly, this is the logic of the Z1. I mean, holy mackerel. How good is that? Z minus 1. Z minus 2, the same thing. Not even close to getting hit. And you get all of the gains that were available in there. And then if you just are trying to squeeze every possible, there's a supported spring crossing. So is this. That one doesn't pay off because this would probably get you out at a scratch. And there's an owl. But then this one, that one pays off, even if you just got out in the fall and getting close to the end of the day and you're worried about a return to the VWAP. The fact this thing didn't go to the VWAP, watch it go tomorrow. Get a chance, pull up, just pull up Cliff on the daily chart, and it's slow to load. But just go look at Cliff on a daily. I mean, we talk about this stuff for hours, but it's the same pattern. Got to give you time to prep. You guys take good care. More to come. God, I wish I could have gone through all those charts. Keep your wrist measured and your powder dry, guys. There's gold in those hills. Supported spring crossing. Simplified exit strategy. Take a look at that flashcard. And Z0, Z1, Z2. There's a reason why you could just set it and forget it. I'm probably going to end up doing a separate workshop just on that one for one weekend and just train that pattern and, not even do all the deep ecosystems and all that other stuff. Just so that people could just learn that thing and do it. I just think like you got to know the ecosystem if you want to be self-sufficient for the next 30 years. I'm 62. I don't know how much longer I'll do this or can do it. I mean, who knows? So that's why I'm trying to document the ecosystem in such detail, just because. So trade well, live long and prosper. Remember, the ecosystem sets you up, but when you walk through the corridor and get into the battle circle, that's not where you start thinking. You stop thinking there and you are performing, you are acting, you are fighting, or whatever your metaphor is. That's where your battle drill takes over. Planning and preparing is one thing. That's what we've just done for 2 hours. But in the trade, you're executing and assessing. There's no mind in that. It's all being. Planning and preparing is for your head. Executing and assessing is your heart and your guts and your hands and your feet. It's everything else. Keep your head out of the fight. Don't lead with your head. Protect your head. Keep your wrist measured and powder dry, guys. Otherwise, I'm going to go for another hour. And we'll see you tomorrow. Take good care. God, I'm glad I recorded that.